Hello traders, this is Dan, Chief Options Strategist for MasterTrader.com, and in this video I'm going to explain to you how and when are the circumstances that you can be assigned the underlying stock or ETF when you are shorting options and credit spreads. Let's begin. Just a reminder here for our members, log into your members area at MasterTrader.com, and there's a lot of great information in here. But in particular, your products are the things you subscribe to or get free, the chart of the week. The resources are everything listed right here. Very important documents for stock and option traders. When you're starting off, you're excited. I know you want to run right to the trades and start trading, but this is going to ensure or help your path towards trading mastery. We have a glossary here of the terms we use, how to read our trade alerts. We have short videos on the typical option strategies we trade, guidelines for trading the open and gaps. We talk about the strategies here, universe of liquid options, and most importantly, money management when selling these option spreads. Selling these credit spreads are just wonderful income strategies that we use in all market environments. They're easy to find and manage, but you have to manage them intelligently, as we do with the charts, to limit the downside risk when they go against you. Let's go to basics here so the idea of assignment will sink in. When a buyer buys an option, a call or put option, what does that give them? They're paying money for the right, not the obligation. They have the right to buy the underlying, that would be a call option, or they have the right to sell the underlying, that would be buying a put option. The underlying can be anything that's optionable, a stock, ETF, commodity, whatever, on or before expiration date. So these rights expire. When you buy an option, you're considered long. The seller of the option now, they're receiving the money that the option buyer paid, and they have an obligation. What are their obligations? Well, if I sold a put option, my obligation is to buy the underlying. If I sell a call option, I have an obligation to sell the underlying. Again, on or before expiration, that's considered being short the option. The OCC, Options Clearing Corp, is the organization that matches up all these orders and keeps an orderly flow of option contracts to make sure that the obligations are adhered to among the market participants. They will auto-assign the underlying stock or ETF if an option expires 1 penny in the money, which means it has intrinsic value. But bear in mind that the option holder, the holder being the long, whoever bought it, they're long, they're called the option holder. They have the right to make an exercise notice to their broker by the deadline, even if the option expired out of the money at 4 p.m. So even if the OCC does not do auto exercise because it's not 1 cent in the money, you can still be assigned over the weekend if you are short an option. So sit back and ask yourself, well, why on earth would that happen? Why would an option holder make an exercise notice on a worthless option? A visual will illustrate this. This is the S&P ETF, the spiders 5-minute chart. You can see it had a beautiful run into the close here. What a beautiful trading pattern here. Wow, nice 180 reversal breakout. At 4 p.m. Eastern, it closed at 270.98. So let's assume that we were short and out of the money $270 put. So that's 98 cents out of the money. So there is no automatic exercise by the OCC, period. That's step one. Let's see what's happening after the market though, folks. 5 o'clock Eastern time. And I'm going to assume that is the deadline for making an exercise notice because I trade on Thinkorswim, TOS, and that's theirs. Some brokers might be earlier, like 4:30, so I encourage you to call your own broker and ask them, what is the deadline for me making an exercise notice? So at 5 p.m. it closed at 267. That is $3.98 lower than the closing price. So if I am long a 270 put, I'm the holder, Based on this number, I have $3 of intrinsic value, correct? So that would be beneficial for me to make a exercise notice. Why? Because I have the right, being long the put, to sell the stock at $2.70 a share if it opens up at $2.67 on Monday morning, even pre-market where you can trade on ECNs. Then I have a $3 profit there. So that would be a reason that you would make an exercise notice, the long put holder. And I'm just showing you here that the ECNs, continue to trade here, and it went all the way down to 267 at this point in time. Let's continue. This is the daily chart now. I showed you the intraday charts. So it closed at 270.98, as I showed you. The next trading day, look at this. It opened, so that's the close. This is the open at 240.97. Folks, $30 lower it opened. So do you think the person who was long the 270 put, who made the exercise notice, is happy? You better believe it. And do you think the short seller of that put is not happy? Let's go through it. So let's assume the put holder made a timely exercise request to his broker. He is exercising his right to sell spiders, and that represents 100 shares of the ETF for every one contract at the 270 agreed strike. So over the weekend, when the OCC with the broker is matching up all of these orders after expiration, shares will leave his account. In parentheses, I say, or be short, because what if he doesn't have the shares to sell at 270? Then he'll be short. At the $270 share will be credited to his account because he's selling them. That's what he had when he bought the put. Now, also over the weekend, the trader who was short the 270 puts, what does being short a 270 put mean? Well, it means that I'm agreeing to buy the spiders at the agreed upon strike price on or before expiration. So spiders are going to be deposited into my account. I'm now long spiders, and $270 a share is going to be debited. I got to pay for them. Broker risk and exercise request deadlines. If you don't have the sufficient buying power for the position assigned, you will get a margin call over the weekend. So assume we had that $10 put spread, for example, and the buying power required to sell a 10 lot is the spread width less premium received. So let's just say we took in $1. That's only $9 a share. $9,000, let's assume, on a 10 lot. But now if you're assigned 1,000 shares of the SPY to buy at $270, you're going to have a margin call. If you have trading a small account, broker margin departments can also close out your position without notice. Their risk is paramount. So they can close out your position prior to the market close to protect their risk and this margin call to you. Now, some people refer to this as a pin risk. Let's just assume we have a 10. This actually, I pulled this from one of our traders. He was short an Amazon $20 wide put spread, and it was trading just above it, so it was still out of the money, but it was coming dangerously close, and they refer to pin risk there based upon how many contracts are out of the money and in the money. There's kind of this tendency for it to drift towards that strike price into the close, but don't even worry about that. What happened was this trader, even though it was profitable and Amazon rallied into the close to close even above $18.80, $10 out of the money, his broker still closed him out. Why? They saw risk of it closing under $18.70 and creating a margin call. They didn't want a margin call for this particular client. The OCC will not accept a execution order of exercise after 5:30 p.m. Exercise or do not exercise request, so that's the D&E, Contra exercise for equity options must be received by 5 o'clock Eastern Time at Thinkorswim. So let's think about this. The OCC, as I said, will exercise 1 penny in the money at 4 p.m. prices. They will also not accept an exercise or do not exercise notice from the broker firm after 5:30 p.m. Hey, it's their rules. There's nothing to change about that. At TAS, it's 5 p.m. Call your own broker, as I said, to see if it might be earlier. I seriously doubt any of them are after 5, because then TAS says, hey, any requests between 5 and 5:30, if you're a good client, we'll try to process it on a best efforts basis, but they have the right to say, no, you missed our 5 o'clock deadline. The only 100% way to not get assigned if you're short options is to close a short position prior to 4 p.m. Now, yes, there's certain index and other ETFs that continue to trade until 4:15, but they're going to be less liquid. Don't get into that habit. Close them prior to 4 p.m. If you don't want any risk of assignment, close the short options prior to 4 p.m. We recommend you do that to prevent margin calls or just any surprises, unless you genuinely don't mind being assigned the underlying stock, either long or short, based on your trading plan. That's fine. In reality, though, it depends on what's going to happen post-market after the 4 p.m. close, and if the underlying, moves. If it continues to move in the direction of being out of the money, you ideally have nothing to worry about. Additionally, the option holder should be watching to see what the underlying is doing in order to make an intelligent exercise request. Is the spider example I showed you, where there was $3 of unrealized gain based upon the close post-market after an hour. If the holder does exercise, both parties, the long and short, will be taking the gap risk until trading resumes. As the example I showed you, the put holder who exercised the right to sell had a $30 gift when the market opened the following day on those spiders. But there's plenty of examples where the opposite would occur. He could have made an exercise notice and it gaps the other way, and then he's lost money. So there's, gap risk on both parties. But traders, you just got to have the patience and discipline to follow your own trading rules. Finally here, post-market option trading and select ETFs. You can trade stocks and ETFs outside of the NYSE market hours. It's a more advanced strategy, but you can also you trade stock and ETFs as a partial hedging strategy around your longer short option positions. We teach some of that in our option courses, but it's beyond the scope of this. And I'm just giving you a little list here that TAS gave me. I'm sure these change. I'm sure many of them are not very liquid, but just bear in mind that these ETFs do trade all the way to 4:15. So another 15 minutes, you pull up quotes on these, and they'll be moving around. Highlighting again the OCC auto assignment rules, however, even on these ETFs, are still based on the 4 o'clock close. It's the option holder's right to make an exercise notice for any reason up to the deadline, 5 p.m. at TAS, regardless of where the underlying is trading. I'm not going to cover it, but in terms of early assignment, there's also a risk of early assignment for those who are short calls that get in the money up to a dividend payment date. And the only reason that they would make an early exercise notice if you were long a call, because when you make an early exercise notice early, meaning, a day, a couple hours or a couple days before the 4 p.m. market close on day of expiration, you are forfeiting your extrinsic value. So why would you do that? And there's just one exception you just got to kind of be aware of, and it revolves around dividends. If somebody says, look, I'd rather own the long stock and give up my extrinsic value on being long the call option because it just mathematically makes more sense. That's kind of one exception. But if somebody stupidly makes an early exercise notice on an out-of-the-money option, other than the overnight gap risk, then you actually have a gift on your hands because you have made the extrinsic value early. Obviously, we teach directional option trading, and this is what we call our income strategy, which is the subject here of selling options and credit spreads around compelling patterns. We have 2 courses here. Advanced Credit Spreads course. It's a great 5-module course, silver. This gold is a very detailed, incredible 12-module mastery course where we talk about every conceivable environment and setup where we have great trading opportunities of selling credit spreads around the charts, earnings, volatility, news, etc. And our platinum package here, it's you get the gold course and then 3 months of our green live trading room and 3 months of our weekly options trader, where we give credit spread trading ideas that all expire 10 days or less, and that's a great service there too. So I hope that helped folks answer all of your questions on when can I get assigned. Good trading, everybody, and we look forward to seeing you soon.